I'm Keith Knapp. I'm going to be your host today, and I'm going to be sharing the trainings on assets that you can use to secure a business loan. And before we jump into that, if you like business loans, if you want to find money for your business, you want to learn how to build business credit, you want to find all these high limit credit lines, credit cards, equipment loans, real estate loans, whatever kind of funding you need to join us at the Funding 50 Challenge. We've done this before with the Funding 30 Challenge. Ty realized as he was going through this process that there's a lot more that he could be talking about. So we stacked on another 20 different funding options to talk with you guys about. So a lot of really cool things coming up. That's June 26th to the 28th. It's completely free. It's online. We have speakers coming in. We're going to be talking with you guys about all the different ways that you can get funding, help you actually find loans that fit your scenario right then and there, and then work with you to just take it to the next level and help you create a plan to be able to get the funding you need. So check it out. If you want more information, you can find that at funding50challenge.com, or you can scan the QR code right here on the screen, and it'll take you right to the page to register. Again, that's June 26th to the 28th. It's free. Great time, always great community, great people there. A lot of fun. So if that's something you're interested in, make sure you register and join us. It's going to be a great time. All right, so let's jump into talking about assets that you can use for securing a business loan. And as you guys are hanging out with me, tell me hi. Let me know where you're from. Give me a shout out. Tell everybody your business name. Get some free exposure on the live stream here. We'd love to share our audience's businesses, what you guys are doing, and help you out any way we can. So let's talk about secured business loans. I love secured business loans. The reason I love secured business loans is because they give you the most flexibility and most options at the best rates and best terms. So so as you're going through this process, or as you're looking for funding your business, if you have the ability to secure a loan, it's going to go really. It's going to help you out tremendously. Looks like we have a question on Facebook. What's the registration link? Just shared that with all of you guys. So it's funding50challenge.com. So what makes a secured business loan? What is a secured business loan? If you're not sure about that, a secured business loan is a type of loan that requires that you provide collateral or security to the lender in order to obtain financing. Very, very common practice. To put it in perspective, anytime you buy a car is actually a secured loan transaction because you're using the equipment of the actual vehicle that you're purchasing to secure the loan. So, like as we all know, if you don't pay your car loan, they repossess the car because the car is securing the financing. It's an asset that the lender has so that it reduces their risk. So traditional loans versus secured loans, when you're looking at them and you're comparing them, traditional loans are typically looking at just the credit worthiness of the business, and then they're looking at they're looking at your income stability. So they're just when you're looking at traditional loans, like if you just walked into a bank and you're like, hey, I want a line of credit, the two things they're going to look at is one, what does your business income look like? And two, what kind of credit do you have personally, and what kind of credit do you have? What kind of credit do you have for your business? So the reason that I like secured loans, there is just a list of value inside of these secured loan options. So the first one, which is probably one of the best ones, it increases your eligibility. If you guys have hung out with me before, and I'm seeing some of your guys' chats on here, I've seen you on here. I appreciate you guys coming back again. But secured loans are awesome because what it does is it eliminates the risk for the bank. So when you're talking with the banker and you're talking with the lender saying, hey, look, I want to get a loan. If you go to somebody and say, I want $100,000 and I just want to sign for it, it's a lot of risk for the bank. But if you go to them and you say, look, I want $100,000, here's something that I can secure the loan with. Now they're looking at it going, yeah, you know what? It may be a newer business. The business owner may have that personal credit, but if you're able to secure it, then we can recover our costs in case they default, and it reduces the risk level for the bank, makes the banks happy, makes it easier to get it. The other thing about secured loans is because that risk factor is so much lower, you're going to get better interest rates. It's going to help you out to be able to get the best money at the best terms. And and the other side of it, it's going to give you extended repayment periods. It's going to give you more flexible terms. So instead of it being a 12-month a 12-month loan or a 48-month loan, you may be looking at 5 years, 6 years, even up to 10 years when you're securing the assets or securing it with assets. Um, the other side is it's easier for approvals because once you have an asset there, especially depending on the types of assets that are available, banks love it. They just make it easy, like because it really turns into a win-win situation. Because I mean, let's face it, like us as the consumers of the bank, us business owners looking at it as a consumer, when a bank says, "Hey, I want to loan you money," and we say, "Hey, here's my house that I'm willing to put up as collateral," now they start to look at it and go, "Man, this guy's going to fight with everything he has to be able to keep his house. This is a no-brainer. This makes sense." So it's very good to have. And then, like I just kind of mentioned before, it has less personal credit requirements, meaning that if you've got challenge credit, if you're a risky entrepreneur who's gotten out there and taken big risks and made some big moves, and maybe it hadn't worked out the best for you personally on your credit, having that collateral there will reduce the amount of impact of your personal credit. And there's even some secured loans out there that don't even care about your personal credit score as long as the loan is secured. So it's a very good product. It's a very good option to have. So the thing that we have to look at though is that a lot of times as business owners, we get out there and we're like, you may not necessarily have the assets, you may not have the collateral just yet. And so what we're going to do is we're going to look at some of these different types of collateral to understand what your options are, understand what it is that you can put together, and show you some strategic ways that you can invest what you're doing in your business into building these assets so you can secure better loans. So the first thing to understand is, what is collateral? The actual definition of collateral for secured business loan is assets used to pledge or to secure a loan. Hence the name, the reason it's called a secured business loan. So an asset that's pledged to secure it. The types of collateral that can be taken for a business loan, really broken down in different categories. So you've got real estate that can be used. You've got equipment. You've got inventory, accounts receivable, meaning cash flow, anything like that. So those are kind of the primary categories, and we're going to dig into those a little bit deeper here. But the way that those assets are used to secure the business loan is based on an assessment or an appraisal. So, for example, let's say you've got a piece of equipment. Let's say that you're running a construction company and you've got a piece of equipment that worth $150,000 in your mind. What's going to happen is the bank's going to they're going to do kind of a preliminary assessment of it, where they're going to just go online. They're going to look, okay, you know what? It's a 2010, it's a Ford, it has A, B, C, D, E, F, G, it's this model. And then they're going to look at, okay, based on that, the value should be approximately X, or like, let's say it's 100,000 or 150,000, like you expect it to be. Depending on the type of collateral that you're using, they may actually want an appraisal and send somebody out to actually look at it and give a real value based off of that. So that's how they're using that. Now, when they're calculating your loan amounts based on the collateral, there's a couple different ways that they could do it. Sometimes they'll put it on a multiplier, meaning that, let's say you have that piece of equipment that's worth $150,000, and they may go, hey, we're going to put it on a multiplier of 2, meaning that we're going to loan you $250,000, knowing that 150 of it's, or $300,000, knowing that 150 of it is secured by this piece of equipment. And when you get into different layerings, different factors like that, what they're going to look at is the strength of the business. So that at that point, they're going to be taking your personal credit, your business credit, the revenue, and all the income and assets of the company as well into consideration. But traditionally, what you find is if you've got collateral that's worth $150,000, sometimes they may go up to 80, 90% of the value of that asset. It just really depends on the lender. It depends on a lot of different variables with it. But it's something in the process that you need to be aware of. There will be an assessment. There will be an appraisal. So while we're looking at this, the other question we want to answer here are, what are some of the risks, or what are some of the things that you need to be careful of if you're looking at secured financing? The first one, and the most obvious one, is the possibility of losing collateral in case of a default. Like if if you use your house to secure a business loan and that business loan doesn't work, they will come after your house. You have the possibility of losing the collateral or the assets that you have available. And so that's something that you always want to keep in mind when you're looking at a business loan is this something that's going to be viable? Is this really a good investment? Is this a safe investment for my family? Is this a safe investment for what I have personally? But a lot of that can be mitigated through mitigating your risk through proper financial planning, working with experts to be able to look at your business, figure out how much can you really afford, and then working accordingly. So let's dive into the different types of collateral that you can use to secure a business loan. I love talking about this because a lot of times I find that as you start having these conversations, you get those aha moments where your brain goes, "Oh, I've got that. I can secure a loan." So let's see if we can jog some ideas. And while I'm going through these, if you have any feedback or if you have any questions, throw them in the chat. I'm more than happy to answer them. I got my little thing here so that it's telling me who's talking and what you're asking. So if you have any questions while I'm going through this, throw it out here. So first one we want to talk about is real estate collateral. So collateral options that you can look at is, again, the primary categories it covers: real estate, equipment, inventory, and then accounts receivable. So when you're talking about real estate collateral, real estate is just that. It's literally using real estate that you own to secure a loan, and that can be in a purchase situation. If you're looking at buying real estate, obviously they're going to use that real estate as collateral. But when you get into commercial finance and you get into commercial lending, they can also use equity that you have in a property. So let's say you have a fourplex that's worth $500,000, and let's say you own a portfolio. Let's make this a round number because it's the end of the week. I'm kind of tired, so we're going to keep our math easy. But let's say you've got four different units that equal about $1 million worth of $1 million in value, and then you've got loans on them. So let's say you've got $750,000 of mortgages on there, meaning that you've got $250,000 of equity that's free. You can actually use that equity to secure your loans. They'll put a second lien on it, put it as a subordinate to the first mortgage or the primary loan on it, meaning that if it defaults, the primary loan has the option to take have first right of refusal to sell the property or repossess it. But at the end of the day, what they're doing is they're taking all of that collateral or all that equity that's there, wrapping it up, using it to secure. And a lot of times you'll find with traditional banks, this is going to be more like business credit lines, lines of credit, things like that you can use. But real estate's a great option for that. And the beauty of it is when you're looking at commercial, it doesn't necessarily have to be commercial properties. It doesn't have to be sky rises. It doesn't have to be fourplexes, eightplexes, any apartment buildings. It could be a warehouse. It could even be single family homes that you own, the business own that you can leverage that way. So real estate is always great. Banks love real estate because obviously we know that real estate is supposed to, this key word here, and what we've seen lately is that the values just skyrocket. The values of real estate's constantly going up, and so there's a lot of equity there, and it's a pretty safe investment most of the time. So if you have real estate, that works. Some of the things that you can use inside of real estate. So again, it can be commercial properties. It could be residential properties. It could be warehouses. It could even be land. If you just own land that's out there that maybe is undeveloped or land that you're going to be building something on in the future, you can use that to secure it. There's a lot of different options that you can keep in mind with that. So that's real estate collateral. Next one we want to talk about is equipment collateral. Equipment, I find, is a lot easier for a lot of companies because sometimes, like I know that there's things that I consistently do that I own, that I run a business with, and I don't even you kind of just stop thinking about it because you use it so much. It's just an everyday part of your life and what you're doing on a daily basis that you don't really you just don't think about it. But you can actually use equipment as collateral for a secured loan, and this could be machinery. So like if you're running a t-shirt shop, you've got print screeners there. If you're running a construction company, the tools that you have, especially when maybe not like power drills, things like that, but as you start getting into some of the bigger tools, the bigger equipment, if you have bobcats, you've got all this different thing, all these different assets that you have to buy to get the job done. That's equipment that you could potentially use as collateral to secure a business loan to grow your business and get more with it. And so vehicles are another one. And now here's a nice little trick. And this is something that I think a lot of business owners haven't caught on to yet. So I'm going to give you this magic little formula for secret just for hanging out with me today, and it's going to be good. So vehicles can be used to secure a business loan. Now, how does that impact you? You can use a vehicle to secure a business loan, a secured business loan, low interest rates, all that stuff in over here. But also you can purchase vehicles with just business credit, no personal guarantee. So essentially, you as a business owner can come over here. You can build your business credit. You can start building your fleet of commercial vehicles that your company is going to be used, and then get those paid off, and then use them as collateral to be able to get a secured loan and to be able to secure better financing. So essentially, you could go out, you could use your business credit, build your business credit, use it in a way that you're able to purchase all these company vehicles, you get them paid off. Now you've got assets that's collateral. So now you still have this over here as an asset that's making your business money that you're able to get out there and earn off of. But now you can also collateralize it, so you can expand your business even further and use that to leverage your business loans. So it's just a nice creative way of thinking about how you can invest, not even your money. I mean, because essentially what you're doing is you're buying a company vehicle based off of business credit. You're making money on it, and then you're just paying it off because you're making money with it. It's a tool, it's a piece of equipment, and then you're able to leverage that into a bigger loan in the future. Maybe use it to secure like an SBA loan. I mean, there's a lot of cool things that you can do with that, and now you've done it without personal liability, which even just makes it even better for all of us. It makes it better for you, makes it easier at home, less stress, better life. So equipment, again, maintain your equipment as you're going through it. The better condition the equipment, the higher the appraisal, the higher the value is going to be. So make sure it's always in working order, which I know if you're using equipment on a daily basis, I'm sure that's something that you're doing anyway. So that's equipment collateral. Next, let's jump into inventory. Inventory, I think, is always a creative way, especially for those of you guys who are running like e-commerce shops or you're running retail businesses. Inventory is a great way to be able to buy low, have your supplies there, and then still use that as security. Some of the benefits is it's a marketable goods as loan security. So basically, you're able to take something that you're going to turn around and make a profit on and use that to secure a loan, meaning that you can take that inventory, get working capital to be able to market and sell it, make money on it, keep your inventory stocked, and have a working line of credit based off of that. Part of what you need to be careful of with that is just managing your inventory levels and valuations, making sure you're investing into things that are going to sell, things that are going to move, inventory that actually makes sense. If they walk into your business and they see that you've got a widget there that nobody's buying from the 1970s and it's just obsolete, that's not inventory that a bank's going to use. That's not inventory that you can use, because essentially it's not anything that you could really sell on a mass scale and make money off of. So inventory is another great way. The third way that you can secure business loans is accounts receivable collateral. Accounts receivable, this could be your cash flow, business revenue financing. It can also be merchant advances. So the credit card company, the credit card processor that you're using to take payments can be used to secure financing. And then one of my favorites is the unpaid customer invoices as loan security, meaning that if you're invoicing clients and you've got $100,000 worth of outstanding invoices, you can use that $100,000 of outstanding invoices to secure a loan. And a lot of these times with these AR factoring companies, and if you just want to look up more, it's actually called AR factoring. But these accounts receivable factoring companies, what they'll do is if you give them that $100,000 of invoices to secure the loan, they'll give you maybe 80%, not 85, 90% of the money back. And then they'll actually do the collection on that. So instead of you getting paid the $100,000, you may be collecting $90,000 up front. and you're losing $10,000, you're paying $10,000 in interest, but you don't have to collect. The bank's going to collect on it. The AR receivable company is going to be taking over the collections of those. Now, the other option that I think is really beautiful with this is if you have a bunch of outstanding invoices, because anybody who's ran invoices, you know that there's always depending on your business model, it usually ranges from 7.5 to 15% attrition rate, meaning that you on average you're always going to have 10% of your clients who aren't paying your invoices that you're going to have to charge off. Those can actually be used for AR financing as well, which I think is another really creative way to get the most out of your invoicing, get the most out of your money, get the most out of clients who maybe aren't paying. So a lot of good things there. So that's your account receivables, ways that you can use that. So last one, last one is cash or money securities. And this is going to be ones that we talk about often. This is going to be stocks, bonds, mutual funds, CDs. CD rates right now look better than they've ever looked just because mortgage rates are so high and the Fed rates are so high. The CD rates have actually gotten to the point where they're paying 5-6% again, which we haven't seen. I don't even remember the last time I saw that. I'm 44, and I mean we're just now seeing good rates and good interest rates coming back on CDs, which we haven't seen in forever. So it's awesome. A lot of good things that you could do there. Now, if you think about this though, what they're saying and what the banks are telling you right here is that if you have good enough consistent cash flow, you manage your books right, you have your reserves, you can take those reserves. You may have a working reserve account that's just kind of like your general savings, and then you've got another account that you're constantly investing into CDs. You can use that CD to secure a business loan. So now, even if you're paying a 7% interest rate on your business loan, if your CD is making 5, you basically have a 2% interest rate on a business line of credit that's being secured by money that you already have on hand. So a lot of cool things, a lot of really creative ways that you can leverage your cash flow, that you can leverage your business to be able to get the loans that you need. And then the last one are corporate bonds. So stocks, bonds, mutual funds, anything like that. Anytime you have an investment account, there's always things you can do with that. The CDs, I think, is just a great kind of bootstrap strategy as you're getting up and going to be able to do that. So now that we've talked about all the different types of collateral, what you can use for it, let's jump into some things that you need to keep in mind. The first thing, loan applications and documentation requirements. They're going to do a collateral evaluation. They're going to do an assessment, maybe even an appraisal, depending on what you're using for collateral. So keep that in mind. If you're going to use something, they're going to want to see it. You know, they're not just going to say, "Oh, you've got $100,000 in a CD. That's cool." They're going to verify it. They're going to want to see it. They're going to want to see the documentation. The next thing they're going to look at is loan to value ratio, or LTV, and loan terms. So depending on how much you're borrowing, if you're putting any money down on some of the bigger loan options that are out there, that's going to play into it. And then again, they're going to look at the securing instrument, and then base that off of, and then base how much they're willing to pay you or loan you based off of a percentage of that security amount. So how can you get ready? The simple way to get ready: conduct a thorough assessment of the loan requirements and in your ability to repay. Again, if you're securing it, especially if you're using some of your personal assets like your home, your vehicles, things like that, make sure that you're ready for the loan before you take it. Don't take out loans just because they're available. Make sure your business is ready. Make sure you got a good plan that you're going to get a good, solid, strong return on investment with it. Seek professional advice from financial advisors and lenders. I owned a business before, and I got myself in trouble with it. I grew too fast. I had too many sales and didn't know what I was doing on the admin and operational side, and really put myself in a bind and got in trouble. And all of that could have been avoided if I would have just talked to a financial advisor. If I would have talked with advisors, talked with planners, and sought advice from lenders. Not necessarily lenders who were trying to sell me their products right then and there, but just doing my homework, doing a little bit more due diligence. You can save yourself a lot of headaches, a lot of trauma, a lot of sleepless nights. But seek advice. Find people who you can talk with. Find people who will shoot you straight on it, who will give you good, solid, sound advice. And financial advisors are a great way to look at that. And then the last thing is understand the terms and conditions of the loan agreement. Don't ever get a loan if you're so desperate that you need a loan that you're not willing to read the terms and conditions and your agreement, not understanding. You're on a path that's dangerous, and that's when you really need to talk with your financial advisor and see if it's viable for or even smart for you to continue going or restructure the business, find some ways to go about it. Always understand your terms and conditions. Always read through them. With a lot of the bigger banks, a lot of things like that, you're not going to run into anything weird. But as you start working with alternative lenders, you start working with some of the smaller banks. Sometimes they like to slide things into those terms and conditions that you just need to keep an eye out. Not that I think that anyone's trying to just willfully take advantage of you. I think sometimes they have it in there for their security, but they don't understand or think about the impact it has on everybody invested. So understand your terms and conditions and look through that. Now, we covered a lot of stuff. If you need help finding a secured business loan, we would love to help you. If you have questions about it, we're always happy to help. You can schedule a free business financing assessment with us at creditsuite.com/consult. Take a picture, jump on, grab the QR code. You can schedule it right there online. We'll sit down with you. We'll look at your business, make sure your business is fundable, make sure it's set up properly, look through your credit, make sure that you're ready, and even help you find business loans that you qualify for right now, and work with you to be able to create a plan so that even if you can't get a secured loan like right now, or you want to secure an SBA loan or traditional loan, we'll work with you to get your business fundable, to get it to that point within the next year, maybe even 2 years, to get your revenue up, get everything in order, to be able to get that better money in the future. So we would love to help you out with that. If you want to learn more, you can check us out at creditsuite.com/consult. You can scan the QR code and schedule your free business financing assessment, talk with one of our account executives, and see how we can help you out. That's all I got for you guys today. Thanks for hanging out on me on this beautiful Thursday. Hope you guys have an awesome day. If you have any questions, you need any help finding business loans, you need any help talking through any of your options, feel free to leave a comment on this video. We're always watching, more than happy to help you out however we can. Have a great day, and we will see you guys next time. Thanks.